Okay, fresh records for the market. The Nifty now well above the 23,800 mark, flying away as we speak. The Bank Nifty is just surging. There's no stopping this market. Large buying from FIIs as well. Trudip Bhattacharya, the CIO equities at Edelweiss AMC, joins in now to discuss market fundamentals, his top sectoral picks. Trudip, this is really great tidings for the market. I mean, you know, it's in its full glory at the moment. I mean, you know, overcoming every wall of worry. How are you feeling about it now? Do you think this trend is something that can continue, and how do investors approach it?
Yeah. Hi, how are you doing? Thanks for inviting me to your show. I would say that overall, I think the markets, the underlying current of the market is changing over from macro to micro, which is something which we are closely watching. With the elections out of the way, and with the budget right in front of us, and the earnings season of for the June quarter, we think that forthcoming data points would be more about more dominant on earnings rather than kind of, you know, of course, after the budget, once we know the key policy details, the second half of the year would be mostly earnings dominated, and that's where we have our focus on. In that context, whether the government balances the historical areas of growth like industrials along with a bit of populism, that needs to be kept in mind. But net-net, I think the headlines would be a lot more about earnings in the second half of this year rather than macro announcements that we have seen so far.
Trudip, morning. You manage a lot of funds, the mid-cap fund, small-cap fund, and that's where all the interest and activity is. Have you made any changes in your portfolio or the way you're approaching it now?
Yeah, I think one of the fundamental tenets that the market is likely to change over the next 12 months versus last 12 months is moving from basically a margin-led growth to a top-line-led growth. Basically, coming out of COVID, a lot of operating leverage has flown into higher earnings growth than top-line growth, which I think from fiscal year 25 onwards will get into more balanced, and hence companies would have to generate top-line growth to generate superior earnings growth. So with that background, I think two of the areas where we find top-line opportunity to be fairly strong are the areas that we've added. The first in that context is basically, I would point to the data center exposed companies. I think what we have figured out based on research over the last few months is that this is one area where, in terms of capacity, is likely to double every 2 years over the next 5 years. And hence the companies which provide nuts and bolts to these sort of companies, the data centers and whatnot, will clearly have superlative earnings growth. And exposure to this area is something that we have added on to, particularly in the mid and small cap domain. The second area that we have added on to are the component companies. These are the companies where, with a lot of capacity coming in from Apple, from Micron and other global companies, the supply chain of these companies would see a major benefit over the next 2 or 3 years. Again, we can't get into stocks, but companies exposed to these two supply chains is something that we have taken particular liking to over the last 2 or 3 months in our portfolios.
So Trudip, I understand you can't name the company that you have bought, say in the data center business, but at least can you tell us the 5-6 companies which are present in this particular sector, and then our viewers can do their own due diligence? And how do the valuations stack up? Because right now the concern is that, you know, all the stocks are expensive. So, you know, first just tell us all the listed companies where, you know, the exposure is there for data centers, and how are the valuations?
Yes, I think basically rather than, again, getting into specific names, I would point out to two parts to the data center opportunity. One is the asset owners, the companies which provide the land, and they are the real estate companies which are exposed in there. And second are the companies which kind of, you know, provide some nuts and bolts to data centers, which could be gensets, which could be power supply or some specific type of maybe transformers and areas like that. So these are the few parts of the supply chain of the data center business, which taking exposure to, particularly over the next 3-5 years, could add to good amount of maybe kind of growth or earnings momentum to the portfolios, and that's something that we have taken a good look at.
Got it. So you said data centers, the companies that provide infrastructure to data centers, and of course the ones that you just spoke about. Any other areas where you see a lot more traction? I mean, the government has a thrust on several areas, right? Whether it's defense, whether it's railways, whether it is new energy, anything in those spaces that you still like despite the rally?
So I think what we have also, so the other area is the component companies, the component companies which supply on to the ultimate supplier being TSMC or Apple or those Micron. Those would see a material benefit over the next 3-5 years as well, driven by PLI. And I think we would expect some sort of a component-related PLI scheme to be announced alongside budget, or maybe over the next 3 to 6 months. So that's one area where we have taken meaningful exposure to. The third is we've gone in a little deeper in the context of railways, where while historically, of course, demand in real estate in railways has gone up. But if you look at the electronics component in the context of railways, is likely to increase manifold, because the incremental spend is likely to be in areas, whether it's Vande Bharat or various different wagons. The electronic component is likely to go up materially. So companies that benefit from the same would see strong earnings come through. Lot of ordering that will come about in that area as well. Defense continues to be our favorite, so there is nothing new in there. I think there we have taken a particular kind look at the PSUs, because we find the valuations of some of the private sector defense exposed companies versus what they bring to the table very high. And our exposure in that context is more exposed to kind of the PSUs, and we think they bring certain expertise over the last 20-30 years, which at the moment, if you ask me, are better than what we see in the private sector companies as of now. So that's how we are looking at defense as well.
How are the valuations of the PSU defense companies, Tridib?
Clearly higher than what we used to deal with a couple of years ago.
Yeah.
But I think what we particularly analyze with a keen eye is the size and the duration of the order book. What we find is that while these companies were historically neglected with kind of no focus coming in from the government or otherwise, the order books for the next for these companies for the next 5 to 10 years look particularly robust. So the longevity of growth is what makes us positive. And because kind of I'm making a statement on defense, let me also calibrate saying that we are looking at obviously the PSUs where valuations are relatively lower, as opposed to some of the private sector ones where valuations have really kind of crossed over to stratospheric heights. So we're mindful of valuations, but at the same time we realize that with about 5-10 year order books full, I think the operating leverage that some of these companies could see could be interesting to sort of participate in over that time frame.
Okay, well, we leave it at that. Thanks a lot for joining in and speaking to us.